Hey, good afternoon, everyone.
Good afternoon,
Good
Professor.
afternoon.
Hey, good afternoon, Daxton and Peter. How are you, Ethan? Ethan, are you here, Ethan? Well,
Yeah, I'm here. So I'm,
how are
I'm
you? Good afternoon, Ethan.
yeah, I was just saying.
Um, okay, good. Sounds good. Well, we have only three people in here collaborate. Um, what happened? Also, in today's forum, well, exactly three people. Ling Chen. How come Ling Chen is not here yet? Ethan, you are in Collaborate, but you must also sign into today's forum because otherwise you're not validating your attendance, right? There's no physical proof without signing into today's discussion board. There is no physical proof of attendance. Okay, um, so please do that. Um, okay. Uh, I had to close the window. Some noise from us. So in our last class, we um, inadvertently the discussion digressed from the main topic, and we were well. It was a good thing we were ahead. Kind of, we were ahead of. We are behind the main lecture. We are always behind the main lecture. But the what I'm talking about is compared to other sections, other classes. Your section, we were fortunately uh, slightly ahead of the curve, so uh, we could have the luxury of digressing from the main topic. But the gap has closed because other classes Monday and since Monday other classes has closed the gap, so we must continue with our main topic. So in our uh, the class before the last, so last Tuesday's class, we were basically talking about how promissory note is factored. And again, factoring um, factoring is, in other terms, uh, it's called a simple discount. Uh, this is jittering. Simple discount means discounting by simple interest rate. So promissory notes and accounts receivable, and accounts receivable in this case means invoice. Now think about it. Accounts receivable is only a concept. Uh, they just in accounting classes they just call it accounts receivable without specifically without nailing what it is, because think about it. Promissory note is a concept and the actual thing, actual physical thing as well. I mean, promissory note has a physical form. It looks like a check, right? The only and it's got you write down the amount, and then you write down the interest rate on it, and then you write down the maturity. So it looks like a check, but the difference is that it has interest built into it, and it has time to maturity um, specified on it. So it's in physical form. It's a paper. But what is an accounts receivable? I mean, accounts receivable is um, only a concept. It's an idea. Then what is, because semantically it just means it's something to receive yet, right? But then what is the actual thing? The physical form. What's the actual physical form? And I've been telling you, invoice is the physical form of accounts receivable, right? Now, then, as I explained last time, you received, a promissory note. Let's say with so you received a promissory note, right? With the principal maturity value. Okay, maturity value is basically principal or the plus interest. So it's like future value. Maturity value is future value, of course. And let's say it was principal was $300,000. Right? So in our example, Dell sold 1,000 units of Model X, right? So basically, this is $1,000 units of Model X. And each Model X is $300. Of course, this is the manufacturer's price, right? It's manufacturer's price. So Best Buy bought 1,000 units of Model X, so they owe them $300,000, right? And I told you, sellers don't like to take promissory notes. I explained this from the seller's perspective. The most preferred payment modality is cash. That's number one. Number two, a credit card or check. I mean, the order would be probably credit card, because the minute you at the point of sale, the credit card company will pay you, right? As soon as it's the information is entered. I mean, as soon as the transaction happens, right? The credit card company will pay you that amount, pay the seller, and the credit card company will give you the buyer 1 month leeway or 1 month deferment, right? They defer the payment for 1 month, but eventually 1 month later, buyer will pay, and that's the maximum time you can buy, 1 month. But in case of promissory note, you can buy up theoretically up to 270 days. But nobody takes, as I told you, commonly, most common um, maturity on the promissory note is 60 days, right? Uh, and most sellers want to collect it within 45 days. They will try to collect it within 45 days. Um, and the third preferred method is, check, because check doesn't take more than 3 days to 7 days max, right, for the check to clear. And the fourth, or the least preferred payment modality, is a promissory note from the seller's perspective, right? Because it can the maximum. It can be like theoretically up to 270 days. Nobody wants to take 270 days promissory note. That's like killing your business. Um, so from the buyer's perspective, that's why it's the most preferred payment modality. But since sellers are unwilling and reluctant normally to take the promissory note as payment, what the buyers do is to pay interest on that, right? So the interest should be at least something equivalent to the prevailing market interest rate. Otherwise, there is no point, because if the seller received this $300,000 at time zero, right, at the point of transaction, then they can put it in the bank and at least earn the average market rate, right? But the only reason the buyer is paying with promissory note is because they can use this money, right, for the next 60 days or 90 days. They can use this money and put it into an investment opportunity that pays, like that can pay 10% for, let's say 90 days, and 10% over 90 days. And let's say you pay only 3%, 3% on the promissory note, then this is automatically, it goes without saying, the promissory note is already paying for itself. It's paying for itself, isn't it right? It's already paying for itself, meaning, look, I get 10%, right? I don't pay cash, so I preserve, this cash, but instead, this cash of 300,000, I put it into some investment opportunity for 90 days, and then my return is 10%, right? And from that, I can pay 3% interest on the promissory note. So I still have then 7% left over. So it already, promissory note is already paying for itself, right? So that's why the buyers, prefer to pay with promissory note in B2B. Okay. The thing is, the interest will be, if it is, at 10%, this will be, 30K. So the maturity value will be 33K, right? Oh, I'm sorry. 10% was the alternate, investment opportunity. So what I was trying to say was, we assumed, what's going on? At 3%, right? for 90 days. It's going to be, and one thing you have to remember is that the rates are all quoted as annual. So 3% or 10%, it will have to be annual under normal circumstances. But just to make our thought experiment simple and easier, we assume this is, we are, assuming that 3% or 10%, that's just for 90 days, right? Over 90 days. Then with 3%, it's going to be 30.9K, right? 1% of 309K, I'm sorry. Oh, what was I thinking? 309K. So I should also 309K. So that's the maturity value. And then when you, so for 90 days, right? So let's, okay. With time to maturity, 90 days. Now, suppose you receive this promissory note today, and that today is time 0, right? But you can hold it. You can hold it for the entire 90 days, and then you present it to the issuer or the buyer, right? Buyer or the issuer of the promissory note, and then you can collect 309K. Whereas you can take it to the bank even on day 1 or at any point in time. And the reason for that is because I've been telling you, most small businesses, I mean, even big businesses, but generally more small businesses are more tight with cash flow, and the cash flow is what makes the company default or not. If you don't have sufficient cash flow, and how do you know whether you have sufficient cash flow or not? You remember the current liabilities, which are short-term liabilities. They are the liabilities. They are payments to make, right? Within 1 year. In other words, so the due dates of these payments are not necessarily all happening at the same time. And some of it is due 2 days later. Some of it is due 1 week later. Some of it is due 1 month from now. Some of it is but all these payments are due at different points in time, but spread across 1 year time frame, right? So that means if the total that you have to pay within 1 year is $105,000, right? Then you must have more than $105,000 in working capital or short-term assets or current assets, because this is what you use to pay for this, right? So then the question is, then do we have, if we have, and then, all we need is if we have just enough current assets as current liabilities, then is it okay? No, it's not okay. Okay. The rule of thumb is the ratio between current assets and current liabilities must be greater than, equal to, or greater than 2. Okay? This is called current ratio. This is called current ratio. In other words, current ratio must be at least, that means you must have at least twice as much current assets as current liabilities. Why? Isn't 1 good enough? Look, if it is just 1, after paying all the current liabilities, you will have no working capital left. If you have no working capital left, then you cannot support the production activity, right? You cannot support production activity. You cannot support, operating activity, right? And you default. I mean, at some point you have to support, operating activity. At some point you have to support production activity. And if you do that, then you won't be able to. Then current ratio will be less than 1. You won't be able to cover the current liabilities, and then you default, right? If you continue to default, multiple times, then the lenders or the creditors won't give you a leeway anymore. Then you will be brought to bankruptcy judgment, and they will sue you. They will take you to the bankruptcy court. Basically, it's going to be a litigation. Of course, the bankruptcy, they won't do that with, I mean, it's obvious that you have defaulted, and you are incapable of paying back. So it's the last resort for the creditors, because they want to then seize your fixed assets. They want to seize your fixed assets, so that and sell off your fixed assets. That's why they take you to the bankruptcy court, and the judgment will be against you, of course. Then they will be able to seize hold of your fixed assets and sell off to recover their loans, right? So, by the way, the point is, if you have sufficient cash flow, you can hold it until maturity, right? And collect all 309K from the buyer. But as I said, most companies are not in that luxury. Most companies, especially small businesses, are constantly suffering from cash flow shortage. If cash flow shortage means you can default, right? You cannot make those current liability payments, right? So most companies generally sell it to the bank early on, like at time 0, right? On day 1. So then the bank will buy it, and basically they negotiate the selling price for this promissory note, which is maturity value 309, and the bank will apply discount rate. That's why it's called a simple discount. The discount rate which is called D, and the discount rate is, let's say, 5%. Okay, of course that's annual. It's annualized rate. So in reality, and time left. So you took it to the bank on day 1. So the time left is 90 days. So then, how much how much do you get after discount? So what you get, of course, they won't do it for free. They will have to, they will have to take something, isn't that right? They will have to take something. They will have to, because by buying the promissory note from you, the bank is basically taking over the risk, right? The risk of default. Of course, if it is a company like Best Buy, a company like Best Buy, and the credit rating will be won't be that bad. The credit rating will be at least above triple B. I mean, they will hardly default, but who knows? Um, any company can default. So the bank is taking over that risk, so they won't do it for free. They will that's the reason they discount it. And then what you receive, B is called bank discount. Bank discount is basically maturity value times discount rate times time, and the time here must be annual. So if it is 90 days in our example, then this is 309K times 5%, which is 0.05 times 90 days. 90 days is 90 over 360 days, right? For if you convert it into a year, right? Because it's a fraction of a year. I mean, in this case, it's very simple. It's 3 over 1 over 4, right? 1/4, right? Now you might wonder, it's a 1/4 of a year, right? You might wonder, isn't 1 year 365 days? Yes, but in simple discount, they have two types of years: ordinary interest year and exact interest year. Ordinary interest year is 360 days. Exact interest year is 365 days. And unless ordinary means that's the default, okay? Unless it is clearly stated, unless it is otherwise specified, right? Unless it is clearly stated that you must use only exact interest year, the default is ordinary interest year, easier to calculate. And this way you can tell what will be, that's the interest that the bank takes out of this. Then that means, then D is maturity value minus bank discount. So that means D is what? That's what you get. What the company that sells the promissory note to the bank is called the proceeds. D. So what is what does that stand for? Oh yeah, of course D would stand for discount, but that is the discounted result of the promissory note. But the name is proceeds. They don't proceeds from selling the promissory notes, right? The bank proceeds. Of course, the difference will be, but again, the formula can be, think about it. You can rewrite it as MV minus, what is the definition of B? What is the definition of B? Anyone? What is the definition of B? Anyone can give me the definition of B? No one? I mean, it's right in your face. It's right in your face. And nobody is giving me. How about you, Peter? What is the what definition of B? The bank discount. What's the definition? The mathematical, I'm talking about when I say definition, I don't like verbal definition. It has to be always mathematical definition. And It's right in your face, but you. How about you, Edgar? Are you there, Edgar? Edgar. Peter, are you
Of
there?
course I'm here.
Okay, Edgar. So what is the definition of B, the bank discount? What's the mathematical definition?
I don't know, to be honest. I'm just catching on to it. BMVXAXT. I don't. Yeah.
You got it right, but this is not X, this is times.
Oh, times.
Is maturity value MV times discount rate times time T, right? So that's the maturity value, right? I mean, that's the definition of B. Yeah, yeah, but you basically, it looks like you've been following at least, um, so think about it. I replace B by its own definition, and then it is MV times discount rate. Uh, this is really, I really gotta, you know, I'm just using a rubber tip pen. So, okay. And then think about it. This can be further, because you can factor out the common factor. If you factor out the common factor, it's going to be MV times 1 minus D times T, right? So basically, you can find it one way or the other. I mean, you can find directly the proceeds, or you can find bank discount first, and then subtract bank discount from the maturity value. But anyway, since we found the bank, and of course, to do it correctly, as I said, all the rates are basically annual, right? All the rates are annual. Because all the rates are, originally we have to do it like this, right? But then let's just simplify it, and let's just say without this, let's just assume that 0.5%, I mean 5% is for 90 days. Let's just assume, and then that's gonna come to I'm gonna write it here. 309 times 5%, right? Clear everything. 309 times 0.05. 0.05, not 0.02. 0.05. And it's going to be 15.45K, right? That means, right? 100, I mean, $15,450, right? So then that means, that makes our D, right? The proceeds, right? Which is, 309 minus that. I'm going to make this No. What's going on? Okay, so 309. I'm sorry, 309 minus. Oh, come on. 309 minus 15.45 will be 293.55. $293.55K. So that means, if you sold it, if this company, which is, Dell, if Dell took, this promissory note to the bank and sold it to the bank with 90 days left to maturity, right? Um, if if the bank applied 5% discount rate, what they will get from this transaction is $293,550, and it's better than, right? If you are under the pressure of cash flow, if you're under the pressure of cash flow shortage, it's better than waiting for 90 days, right? It's better than waiting for 90 days and face the crisis, right? You might run into a cash flow crunch. You're under cash flow crunch, and you might face, a crisis of default if you hold on to it until maturity. But by releasing, by selling this promissory note, you are relieving, right, the pressure on that crisis, right? So all the companies do this. It's called, factoring. In financial math, in finance, it's called, a simple discount, right? The simple discount, that's what I started out with. I said simple, but simple discount, another name for simple discount is factoring. Factoring is what they call it in the industry. But then what is the origin of the word factoring? Huh? It sounds like, oh, it's factoring because you're basically splitting this maturity value of 309 into proceeds and bank discount, right? You're splitting into bank discount of 15.45K and 293.55K by this factor. So that must be why it is called factoring. No, actually, yeah. At least if you think like that, and that means at least you have some analytical faculty. You have analytical ability. You're trying to interpret it by some analytical reasoning. At least, you have some logic going on in there, right? And at least if you think it that way, then I give you points for that, right? Anyway, hold on. So Edgar, since you answered my question, right? And although you probably, I don't know if you, that was just by fluke, but you got it. So I'm gonna give you 0.25 for that.
Yeah, thank you.
Huh? Yeah, you're welcome. You happen to be just, but you were looking at the right thing. As I was, projecting this screen, and then if you were not following, you wouldn't know where to find B, right? So obviously, even if you read it as X, but at least you were looking at the right thing, right? So again, I'm trying to explain why it's called factoring. I mean, you might wonder, does it matter? I mean, the the etymology of the word, doesn't matter. It may not. I mean, actually, to perform this calculation, it doesn't matter. But it's important to understand. It's important to know that, to understand the big picture. What is the big picture? Now, the factoring is not just discounting the promissory note. Factoring originally meant discounting the invoice. And how come? Look, it not every people, especially in the United States, right? If you think you are, and usually, average American, and majority, that means average, so that's majority. Majority of Americans think that they don't need to know anything outside the United States. I mean, they think, knowing, in other words, they are very myopic. Myopic meaning, they're just, a neighborhood community. That's all. They don't think about the global issues, or they don't think about the uh, international conflicts, or I mean, all they think about is, just what they call, typical American lifestyle, which is what, living in the suburb. If you live in the suburb, and rather than, people in the metropolitan areas, it's exceptional. Actually, majority of the U.S. population is living in the suburb or rural areas. And if you live in the suburb, it's your life is pretty much like, what was that? You live in, like Levittown, uh, homes, with a front yard and backyard. Um, your neighbors' houses look pretty much the same. Um, and you have barbecue grill in the backyard. So that type of lifestyle, working 5 days a week, and on weekend you do barbecue in the backyard, right? Uh, if a little, more opulent, you have a pool in the backyard. The kids are, on weekend, kids swim in the pool, and that's all, and they think, life outside U.S., they're not interested. And even nobody is, nobody bothers with a foreign language. And foreign language to most Americans is just Spanish, right? Nobody, knows German or French or Swedish or Korean or Japanese, or nobody knows any other foreign language. And all Spanish, it's only because um, there are it's close to down to earth and close to life, because uh, uh, a lot of, Spanish speaking population, and wherever you go, you might have to. I mean, your landscaping workers are speaking Spanish, or in the building. I mean, if you live in a high rise, and the building crew in the urban areas, most likely, Spanish speaking. So it would be helpful to know Spanish. So very practical reason. But then, then nobody wants to even bother to learn a foreign language, like, French or German or, it was,
Accent?
uh, I'm sorry.
It was an accent.
Uh, yeah, what about accents? What about accents?
No, I
I mean,
said were you asking? Were you asking? Like were you asking a question?
oh, my question.
Yeah.
The question was, I was saying, it wasn't a question. I was just saying, in the U.S., majority of people, right, average American, doesn't bother to learn a foreign language, right? And
Yeah.
most majority average Americans are generally myopic, not interested in any global issues, or not concerned about um, international conflicts, or well, that makes average American myopic. So, but at least the reason I'm talking about this is because of factoring. Where the word factoring, where did that word factoring come from? And the factoring, and if you at least if you think, uh, uh, well, it must be because you are discounting the maturity value of the promissory note by the factor of this, a 5% times I mean the maturity bank discount is calculated by the factor of 0.5 times 1 over 4. And then proceeds will be the difference between the since it is the difference between the maturity value and the bank discount, it is calculated by factor of something. Well, as I said, I'm repeating the same thing already over and over again. If you at least think that way, I give you points for that, because at least uh, someone thinking that way is actually analytical. They have a logic. They have a logic for that reasoning, right? Analytical reasoning. But the reality, most people even don't bother to even wonder about the origin of the word factoring. Not even like that. But the origin of the word is, the French is French. Um, La facture, which means invoice, right? If any one of you knows some French, and in la facture is French for invoice, and that is a common. That kind of word is common. That etymology is common in Romance languages, like Italian and Spanish. And I know for a fact in Italian, uh, French la facture is in Italian la fattore, and in Spanish it must be something like factora. And this is not only in Romance language. I mean, in German it's different, Russian is different, but in Czechoslovakian, in Czech, right? I went to 2018, was it 17? I went to Czechoslovakia, and noticed I rented a car, and then um, of course when you rent a car, uh, you pay in advance. I mean, you use credit card, so you pay in advance. And when I returned the car, then they gave me factura, or factu. It's like factur, right? FAK. Uh, French, la facture. Ah, it's hard to write. With the article le la. And even in Czech and Czechoslovakian is um, a Slavic language, so it's rather closer to Russian. A lot of words are like Russian, common to for example, most in Czech is bridge. In Russian, it's also bridge. But even in Czech, it was like facture, invoice. Of course, it's just a formality because the payment is already made. But usually, invoice is in B2B. Invoice is when you invoices something, the seller sends to the buyer when seller hasn't received the payment yet, right? As I explained before, if Dell has a production plan to build 10,000 computers, 10,000 Model X, then they will need parts, right? Parts and components. And the parts and component manufacturer will ship it without getting paid first. They will ship it. Of course, they are under supply contract. No other company will ship it, just like that without getting paid. But between Dell and this supplier, they have long-term supply contract, something that is binding for 2 years or for 5 years. So when there is a production schedule, production plan, this supplier gets notified. They ship the parts and components without getting paid first. They will just ship it and then send the invoice, right? So that's usually, and then the invoice is, then I told you that is the physical form of accounts receivable, right? From the seller's perspective, from the seller's perspective. From the buyer's perspective, it is accounts payable. It's accounts payable. And when I, in Prague, Czech Republic, when I returned the rental car, they gave me invoice. Once again, it doesn't mean, this is what I owe them because I already paid. But it's just, in that case, it's just a document of a formality that, seals the deal. You are done, right? This is what you have to pay, but, I already paid by credit card, right? But I noticed even in Slavic language like Czech, in Russian is different. Look at the similarity in the word. It's obvious. These words are all related. In Italian, la fattore. I don't know if it is il fattore or it was like la fattore, something like this. So then where did this word factoring come from? Obviously, factoring is from factor, which is, anglicized, right? When these words came into English, it got anglicized, right? Anglicized. So it became factor, right? Of course, in English, invoice is the word, but then because of the effect of these languages, right? Then factoring became. So first of all, factoring developed in the continent, in the European continent, right? They used, invoices. They sold it to the bank. The bank bought it at discount, right? And at the end, the bank will present it to the issuer and collect. And the seller doesn't have to wait until maturity. They can take out the cash in advance from the bank. So that what should I call it? In Middle Ages, in medieval times, I think this this type of factoring already developed in medieval times already, because as there was trades, right? This type of we'll have to call it a kind of technique, right? A financial technique, and it must have developed already in the medieval times and in the European continent. And when it came to England, it got anglicized, right? And so the financial technique of selling the invoice to the bank and advancing the payment was called factoring. Okay, so that is why it's called factoring, right? Not because it is discounted by a factor of something, right? And then this makes it easier to understand why invoices are discounted and why it is called factoring. And I believe there was a question, one or two questions in the quiz one about this. And probably the question was like, in factoring, invoices are relevant or irrelevant, right? Of course, if you understand why it is called factoring, you know the answer. Factoring, the word came from invoice, right? Selling invoice to the bank, right? So that's why it is called factoring, and therefore now that pretty much sums up everything about the current assets. Current assets are normally called short-term assets, but a current means in this case liquid. These are liquid assets, all and all the line items are in the order of liquidity. Cash is already the most liquid. Cash is already cash. Marketable securities, which are stocks and bonds, can be easily liquidated. Promissory notes can be liquidated. I just explained to you how the mechanism. Accounts receivable, the same as promissory notes. And inventory, in manufacturing, inventory consists of three types. I mean, think about it. In manufacturing, there will have to be raw material. Raw material. Without raw material, you can't have any production. And there is goods in process, right? And then finished goods. So three types of inventory, right? Inventory seems like they are physical assets. No, they are not physical assets because they are only physical in nature, but they are not means of production. They are inputs, not the means of production, but inputs, right? And then finally, there is finished goods. But the finished goods for the manufacturer is rarely, not very often included in the, not, what I'm saying is no manufacturer wants to keep their finished goods on site for a long time. Why? If you have finished goods piling up in your warehouse for 2 months and 3 months, what does that mean? You made products that are not selling. That's crazy, right? There's it's a sign of a failure, right? And if you made a product that is selling, then it shouldn't stay in your warehouse for long. They should be, soon as they are produced, they must be shipped out to the retailer, right? It must be shipped out to the retailer. Retailer has placed order, and once it is produced, then it should be in the warehouse or the stock room of the retailer, or in the display aisle of the retailer, right? So although finished goods are part of the manufacturer's inventory, there will be very small portion of that. On the other hand, retailers' inventory consists of only the finished goods, because think about it, it's retailer. right? Retail store. There can be no raw material. There can be no goods in process, right? Now, so that explains, current assets and current liabilities. Current liabilities uh, are short-term debt, right? In this case, current means short-term, um, including they include, notes payable, which are promissory notes. I mean, um, promissory notes that the buyer is holding is their asset because this is, money to collect. Um, but if you're the seller, if you're the buyer, if you're the seller, it's on the asset side. If you're the buyer, the promissory notes that you have to pay is part of the current liabilities because it's something you have to pay. And accounts payable are the invoices you have. It's the invoices you have from the sellers, right? The sellers sent you the accounts, the invoices, and for you that's accounts payable. And then it's actually accrued interest. I just put it labeled it as interest payment because, oops, because they have to match. I mean, this line item must match this line item. This amount, this dollar amount, must match this dollar amount. Okay, but it's accrued interest, and just like other accruals, accrued wages and accrued taxes, they are accruals, right? Now, accrued wages. Let's think about this. Accrued wages. Um, why isn't it just called wages? Why not? Why accrued wages? Now, think about it. Uh, wages are not necessarily paid at the time the labor is performed, the task is performed, right? In other words, if you have a permanent job, right, not a day-to-day temp, if you're just working day to day, you get paid daily. But if you're on a payroll, you get either paid bi-weekly or monthly, right? And if you're receiving bi-weekly checks, right, you get paid on Friday. But suppose, think about it. These statements are okay. What did I say the operating cycle, basic operating cycle of any business is? What did I say? Huh? Does anyone remember? What is the basic operating cycle? Where is? Okay. What is the basic operating cycle? Anybody? Ashley, are you there? Ashley? Ethan, are you there? Ethan? Jamming, are you there? Jamming? How come nobody's answering?
Yeah, I'm here.
Jamming, you're there. Okay. What did I say is the basic operating cycle? Basic operating period. You remember? What are all the financial statements? What operating period are they based on? Anyone?
Is it? I'm gonna just take a guess. Is it just like first quarter, second quarter, third
Yeah,
quarter?
you're right, Edgar. Quarterly, Edgar. You got it. So I'm gonna give you another 0.25. Yeah, all basic operating.
I was the only one to answer. Make that a 1, man. Nobody
What?
answered. Nobody answered but me.
Yeah,
Make that a 1.
right. You got nobody was answering. So yeah, I mean whoever is answering, it takes the gets the credit. So you got another. So it's quarterly. It's quarterly, right? Quarterly cycle, right? That means all the financial statements must be updated quarterly. But for our example, just for our thought example, let's assume this is monthly. They are updating it monthly. Of course, internally they will update it weekly, monthly, and quarterly. That's for reporting purpose of reporting to SEC, Securities Exchange Commission, right? Because at least if your company is publicly traded, right? If your stock is publicly traded, you must report to SEC quarterly, right? But for internal purpose, you can update it weekly and monthly or whatever. So let's say this is monthly statement, and in monthly statement, so you're getting, so at the end of the month, on the 31st or on the 30th, you have to close the book. Closing the book means you update it. In other words, you don't leave it open. You don't leave the data open. You have to update the data, right? So then at the end of the month, but the end of the month is not always Friday. I mean, if you're getting a bi-weekly paycheck, you get it on Friday. But end of the month doesn't have to be Friday. Let's say the end of the month is Wednesday, right? But then that means you will, and it's the Wednesday of the first week after you just got paid. Last Friday you got paid. So then until the next paycheck, you will have like 9 days left, right? You'll have like 9 days left, right? Because you have Thursday, to Sunday, right? Which is 4 days, and then Monday through Friday, so 5 days, 9 days left. So you will only get paid next Friday. Now this is something. A lot of students sometimes confuse. When I ask these questions, they which Friday? If I ask, they say this Friday, next Friday. Actually, to mean this Friday, they say next Friday, but what they actually mean is this Friday. They confuse just because. Think about it. Friday this week is this Friday. It's not next Friday. Friday this week is this Friday. You must call it this Friday. But then a lot of students, they don't have this distinction. They will say, because it hasn't happened yet, it's still to come, they call it next Friday. Look, next Friday means Friday of next week, not this week. But some students, say next Friday to mean this Friday in confusion. So I want to make this clear. When I say next Friday, it's Friday of next week. Okay, so if your paycheck, you will get the next paycheck on next Friday, which is 9 days away. So until then, your wages, you have accrued wages, in other words, accumulated wages of Monday through Wednesday of this week. And the last day of the month is Wednesday. So they have to close the book. And the thing is, this accrued wages for 3 days haven't been paid out. Of course, they don't pay, just because it's the end of the month, they don't pay this wages for 3 days. It will come 9 days later, right? On next Friday. Then think about it. Do we enter this amount? Do we enter this accrued? We cannot, originally, you shouldn't enter it because no transaction hasn't happened. Make sense? It wasn't paid out. It's not it. So all these line items in the balance sheet and income statement, in the financial statements, are the amounts for which the transaction has been completed, right? All these are, think about it. Ending inventory, all these, during this quarter, these transactions have happened. right? But accrued wages is the line item where the transaction hasn't happened. So if the transaction hasn't happened, normally you wouldn't put it there. But then you have to put it there. You're putting it there as accrued wages, meaning that means it's just been accrued and no transaction. It hasn't actually been paid out yet, right? That's what it means. Okay, that's accrued wages. Okay, and the same goes for accrued taxes and etc. So that way we completed all everything about the financial statements, and finally that will bring us to the question of why did we go into the financial statements. And the reason is because we need to we needed to talk about the return on investment from company's perspective, firm's perspective, from microeconomics perspective, right? Because the first topic, ROI, was from macro perspective. First of all, technical definition of what is rate of return, right? Like holding period return and annualized return, right? But then as we enter the second topic, suddenly financial statements. But why did we study financial statements? Because we wanted to look at the return on investment from microeconomics perspective. In other words, from the firm's perspective. How do we measure, return from firm's perspective? But so we are out of time. So this will be discussed. We will continue with this on this Thursday. Okay. All righty. So have a great afternoon, everyone, and I will see you guys on Thursday. Okay. All right. I will stop sharing and stop recording and sign out. All right. No, no greetings. Okay. No, all righty. Take care, everyone. I'm signing out.